So you've decided to take the plunge and that you want to grow your wealth wisely, but you're unsure about what the next steps might look like. Now, investing is a journey of opportunities, of challenges, of emotions, of growth, and of course, self-discovery. It's all about planting the seeds today so you can harvest a brighter and a more prosperous future. As a beginner investor in the UK, understanding the basics of investing can transform your financial landscape by turning your dreams into achievable goals. Now, this video is designed to walk you through all the essentials of investing to inspire you to take that first step and to continue moving forward with confidence. Now, I'm also going to give you some tips that will tilt the scales of success in your favour. And in next week's video, we're going to be building on this subject in more detail, so please make sure that you subscribe so you don't miss any valuable content. Well, welcome back to the channel, and if this is your first time, a very warm welcome to the Economese channel, where together we're going to be learning the language of money and wealth. We're also dedicated to mastering money and making financial wisdom available to all. Hi, my name is Simon and I'm a chartered financial planner here in the UK. Now, one of the most important questions you need to ask yourself is, why am I investing in the first place? Is it to grow your wealth wisely over time? Is it to maintain the investment buying power over and above inflation? Is it to provide a more dignified standard of living in retirement? Is it for tax efficiency? Or is it to give your children a better start in life? So you're going to need to begin with the end goals in mind. Now, goal setting is the cornerstone of successful investing, which is going to help guide your decisions to keep you on track, especially when times get tough. And there's going to be a lot of tough times, but there's also going to be a lot of fabulous times as well. Now remember, stock markets tend to rise 7 times out of 10 and fall 3 times out of 10. We just don't know what the sequence is going to be in advance. So think of your goals as destinations on a map for people of my age, or coordinates on a GPS for the younger viewers. Knowing where you want to go to is going to help you plot the most effective route to help you get there. Now, you need to be intentional and be specific about what you want to achieve. You need to set yourself a timeline and determine how much money you're going to need to get there. Now, in the early days, it might just be that you want to create a positive and a consistent investing habit with money that you are comfortable putting away for the future, which is also affordable. Now, that is also a very worthwhile starting point. But the silent enemy in generating returns is inflation, which gradually erodes the purchasing power of our money over time. For example, if you had £10,000 in the bank 20 years ago and inflation was an average of 3% over those years, your initial investment would now have buying power of about £5,500 in today's money. What that means is inflation would have eroded about £4,500 of your buying power, so inflation is definitely a hidden threat to your savings. So an investment strategy that doesn't account for inflation can leave you with a pot of money that's actually worth less in real terms than when you started. Now, this is why leaving excess cash in the bank can act as an anchor or as a brake, which may mean you can miss your investment goals. So investing in assets that historically have outpaced inflation, such as stocks and shares, real estate, bonds or commodities, can protect and grow your wealth, especially over the longer term. Now, how you decide how much of these asset classes are in your investment portfolio is called asset allocation, and this will depend on your overall risk profile. So asset allocation involves dividing your investment portfolio among different asset categories. And the right mix for you will depend on your financial goals, your risk tolerance, and your investment timeline. For example, a younger investor with a long time horizon and a higher risk tolerance may lean more towards stocks and shares, while someone closer to retirement may prefer bonds and real estate and other historically lower risk investments. And that makes sense. So understanding risk, and importantly your attitude to risk, is fundamental to your investing success. And there are generally 3 types of risk to consider: the level of risk that you're willing to take, the level of risk that you can afford to take, and the level of risk that you need to take. And each of those will be different depending on your personal circumstances and your level of experience. For example, just because you're willing to take a higher risk approach to investing, you may have responsibilities such as a young family, so you may not be able to afford to take such risk with your investments. On the flip side of the coin, of course, you may have started investing later in life and your goal is to make up for lost time before retirement. In this instance, whilst you might be willing to take a lower level of risk, you might need to consider taking a higher level of risk to allow you to meet your goals. So put simply, every investment carries some level of risk. But understanding and accepting the level of risk that you're comfortable with is absolutely essential. Higher risk investments such as stocks and shares offer the potential for higher returns, but they also come with greater volatility. Lower risk investments like bonds historically provide more stability but usually offer lower returns. So you need to assess your risk tolerance based on your financial situation, your goals, and your emotional comfort. And this understanding will help guide you in constructing a portfolio that aligns accurately with your risk profile. At the end of the day, investing is almost always a trade-off in some form or another. Now, the economy moves in cycles, which is constantly moving between expansion, boom, contraction, and recession. As I record this video at the end of February 2024, the UK has just entered a technical recession, which is essentially 6 months of economic decline, and we don't know how long this is going to last for. So at each point in the economic cycle, your assets will react differently to each other. So by having a diversified investment, there is more chance of it performing in all or most economic cycles. Now, we all know that grandma told us not to put all your eggs in one basket, and she probably heard that from a guy called Harry Markowitz in the 1950s. Now, his theory emphasizes the importance of diversification, and he was awarded a Nobel Prize in economics in 1990. So we need to apply some of his theory in our decision-making process. Now, diversification is your safeguard against the unpredictable nature of investing. It involves spreading your investments across a wide and different set of asset classes, different sectors, including different countries. Now, this strategy can help reduce the overall risk because when one part of your portfolio may be down, another is likely to be up. Now, diversification doesn't guarantee profits or guarantee to protect you against losses, but it is a very prudent approach to managing your overall risk. And this is why global multi-asset funds have proven so popular with investments over the decades. Now, this chart, or as we call an investment quilt, it shows us very clearly that sometimes an asset will perform well and sometimes it won't. But a combination of these assets is likely to tip the scales of success in your favor with more stable and more predictable returns. However, in extreme market conditions such as in 1929 with the Great Depression, 1937, 1974 with the oil crisis, 1987, 1992, 2000, which is when the dot-com bubble burst, 2008 with the global financial crisis, and more recently in 2020 with the pandemic. So no matter how much you diversify, this is not going to be enough to prevent these extreme falls, but the market has always recovered over time and with patience. And if you're enjoying the video so far, please consider giving it a thumbs up, hit the like button and consider subscribing. And this is going to help the channel get to a far wider audience. Now please keep watching to the end and you're going to be able to receive a Flipbook which I've created called Investing Through an Economic Crisis, and it's yours totally free. Now possibly one of the greatest risks to our investment success is ourselves. Now Warren Buffett is one of the greatest investing legends of all time, and he said the most important quality for an investor is temperament, not intellect. Now think about that. Temperament is more valuable than intellect. Now if that's true, we can all compete with the very best if we've got the right mindset. Now we love a quote from Albert Einstein on this channel, and here's another one for you. If you can't explain it simply, you don't understand it well enough. How true. Now for us, we need to keep everything as simple as possible and not to overcomplicate things. Now our emotions and our preconceived ideas can significantly impact our investment decisions, and often to our detriment. These can be found in our relationship with money, or what our parents taught us about money by following their example. So recognizing and understanding these common behavioral biases like overconfidence, following the herd mentality, or even the fear of missing out will empower you to make more rational and more objective decisions. So let me tell you a little bit about the Dunning-Kruger effect. Now, the Dunning-Kruger effect is when individuals with limited experience tend to overestimate their skills and their knowledge because they don't know what they don't know. Now, this unconscious incompetence is called the peak of Mount Stupid, when they know very little or nothing at all, and then eventually they slide into what we call the valley of despair as they learn more and more, become more experienced and more competent, but realise that this is a lot more complicated than they thought originally. And finally, rising on the slope of enlightenment as they become more aware and know that there is a lot more to success than they originally imagined. You need to be aware that these biases do exist and they do impact on your decision-making process. So you need to strive to base your investment choices on your research and your reasoning rather than on your emotions and your impulses. Now, investing is very often compared to a roller coaster, complete with all the thrilling highs and the nerve-wracking lows. But controlling your emotions during these fluctuations is absolutely crucial. Now, panic selling during a market dip or even greedily chasing a high can harm your investment portfolio returns. Now, in this chart on screen, it's a little bit out of date, but the lesson to be learned is the same. An average retail investor will generate about half the gain of a standard 60-40 portfolio, and that's 60% stocks and shares and about 40% bonds. And that's because they're continually swapping around and tinkering and always changing their portfolio. They're either greedily chasing gains or fearfully selling into cash, especially when times are volatile. So patience and discipline are definitely going to be your best allies. So remember your long-term goals, which we talked about earlier in the video, and maintain a steady course and don't react on market hysteria or noise. Remember, it's okay to do absolutely nothing and just sit on your hands. Doing nothing at all can sometimes be the best policy. So here are some of the emotions that you should expect to experience as the markets rise and fall over time, and your ability to recognize these to make sure that you don't overreact when they happen. Optimism is where you want to get into the market as many people have made good returns. That's when the excitement begins. Euphoria starts as it continues to rise. But then as markets start to flatten or start to fall, that's when anxiety sets in. But then you're always reminding yourself that you're focused on the long term. As the market continues to fall, you then have fear, then panic, and finally capitulation, where you want to get out at any cost. Be patient, sit on your hands, and don't overreact. As the market then starts to recover, you're starting to feel a bit more hopeful, you have more relief, and then finally we're back to optimism again. Wow. Now, the longer your time horizon, the higher your probability of success. Now, when I started in financial planning way back in 1993, the average holding period for a fund was just over 2 years, and now it's just 6 months. So what does that tell you about how investing behavior has changed over the decades? Now, there is a famous quote from the recently deceased Charlie Munger, and if you don't know who he was the business partner of Warren Buffett for almost 60 years. Now, he said, "The big money is not in the buying or in the selling, but in the waiting in between." Now, another risk to your investing success is going to be the fees and the charges that you're paying. Now, these can include platform fees, broker fees, fund management fees, transaction costs, amongst many others. Now, while they may seem small, over time they can significantly eat into your returns. So make sure you check and compare fees across the platforms and investment products and consider their impact on your potential gains. For example, if you had an initial investment of £100,000 invested over 30 years, where the total fees were just 0.5% a year, the future value of your investment would be approximately £375,000, assuming a good growth rate of about 5%. In comparison, if you didn't have any fees to pay at all, the future value of that investment would actually be more closer to £432,000. Therefore, the impact of fees and charges over the 30-year period, even though they're small, would reduce your investment portfolio by £57,500. Now, this example illustrates how fees and charges can impact the growth of your investment portfolio over time. So make sure you check the fees and the charges carefully and make sure you're getting value for money. So opting for low-cost index funds or ETFs can be a wise choice for minimizing some of these expenses. So if you don't have a lump sum to invest, what other options are open to you? Well, pound cost averaging is a strategy where you invest a fixed amount of money at a regular basis, for example monthly, regardless of the market conditions. Now, we have mentioned this before in previous videos where I've stressed the importance of paying yourself first by setting up a direct debit each month. Now, this approach can help reduce the impact of market volatility and lower the risk of investing a large amount at the outset. So over time, pound cost averaging can actually lower the average cost of your investments, potentially leading to even better returns. So this is because when the market is falling, you're buying more of the fund for the same monthly investment. So when the market rises, your gains are going to be amplified. So how do you understand what your risk profile is? Well, there are many free risk profiling tools out there online, and they're designed to help guide you. They usually ask you a series of questions, and depending on your answers, it will generate a risk profile and a suggested portfolio for you. So in conclusion, investing is a powerful tool for building your wealth, but it's not without its challenges. So you must only focus on what you can control or what you can influence by setting clear goals, diversifying your investments, understanding behavioral biases, controlling your emotions, being mindful of fees and charges, employing strategies like pound cost averaging for regular monthly investing, understanding your risk, guarding against inflation, and carefully allocating your assets so you can navigate the complexities of the market. Remember, investing is a marathon, it is not a sprint. But these basic actions are going to help tip the scales of success in your favour. So stay informed, stay disciplined, and most importantly, stay inspired. Your financial future is in your hands, and with each positive step forward, you're shaping it out to be as bright as you dare to dream. So if you like what you see and you like what you hear, please give the video the thumbs up and then hit the like button. We're going to be creating videos like this every single week, so please consider hitting the subscribe button and the notification bell so you don't miss any future content. And finally, this is your channel, this is your voice. So if you've had a positive or even a negative experience about investing, please drop me a line in the comments below. So thank you for watching the video to the very end. I'm going to leave a link to all the research in the description below, as well as a free flipbook. Thank you so much. Thank you for your time and your patience. I'll see you again next week.